Yeah, let me just talk about the table of contents. What we are trying to discuss today is, we'll start with why invest, then we'll go to why real estate, and then we'll go to why REITs. What has been the global experience? How is the Indian office market? Snapshot of Indian REITs currently and the summary. And the way we want to do this presentation is I'll go through the presentation and we can follow it up with Q&A. Yeah. So let's start. So, why invest? I read somewhere that, rich is someone who has money and wealthy is someone who has time. So you have this concept of FIRE in the US where they say financial independence, retire. What exactly retiring early means is essentially you don't have to work because you don't want to. I mean, you only work on things which interest you. So that can only happen when your financial needs are taken care of, right? And one of the easiest way to do this is through compounding, right? So this is one of the easiest way to achieve financial independence. The process is simple: save, invest, avoid big mistakes, and time is your friend. This is just an illustration of how compounding works, and these numbers are illustrative. You can change it, and accordingly the end result will change, but the message would not change. Essentially, what I've done here is I've shown that if somebody who invests, say, 12 lakh rupees annually into the stock markets, you can remove a zero and do 1.2 lakhs, which is 10,000 per month. And as his salary or income increases, he increases that number by 5% annually, right? So 12 lakhs in year one, 12 lakhs 60,000 in year two, and so on and so forth. And if he is able to extract 15% from the stock markets over a 35-year period, that number becomes, very, very large. We're talking here of to the magnitude of 150 crores, right? And now it doesn't matter where we land up, whether it's 75 crores or 200 crores or 50 crores. The message is loud and clear that if you invest and avoid big mistakes, the odds are in your favor that you would, do well financially. And if you adjust for inflation, if somebody is starting out today for the next 35 years, everything we have to look in terms of real returns, because inflation is, if you just make inflation, then, essentially from a purchasing power point of view, you're exactly where you were. So this data adjusted for inflation of 6% over 35 years is as if saying that you have equivalent of 20 crores today. So if somebody who's investing 12 lakhs per annum essentially has, and then of course increasing with inflation, has roughly 20 crores. Now, former US president once said that the only thing new in this world is the history you don't know. And that's the reason that at least I am very, very focused on long-term histories of the markets across the world. That's something of an area of interest for me, because I think while history does not repeat, it often rhymes. So it's important to know what has happened in the past. So with that in mind, let's look at what are the base rates of investing. So this is a study which happened over 120, this is a Credit Suisse study, which they did over 120 odd years across these markets. And, you can see here Australia, Austria, Belgium, Canada, and the focus should be on geometric mean. You will see that typically, and these are all real returns. So these are all adjusted for inflation. I've highlighted these three things. The UK post adjusted for inflation, you have made 5.3%. US is 6.39%. Europe as a whole is 4%. World ex-US is 4.3%. India here is 6.6%. So essentially, one good rule of thumb which people talk about is 125. What is 125? You will make 1%, and these are all real returns, basically adjusted for inflation. You will make 1% on treasury bills, 2% on long-term bonds, and 5% on equity. When we say 5% on equity, these are real returns. So take 1% here and there. In India's case, historically we have made 6.6%, and similar to what US has made. So we are actually on outlier on the higher side. That's not the global experience. Now let's look at how commodities have provided you returns. You'll see that geometric mean for a long periods of time is essentially close to zero. Now, so the message here is that commodities at best can be a tactical play at some points in time, but these are not long-term uh, assets which one want to hold. And even let's look at gold. Even gold, if you see here, is 0.76% over 100 years in terms of real return. So actually, it's lower than global bonds. But again, these are all cyclical in nature. So there may be a period where they will outperform. But the message is loud and clear, at least as per history, that these are not the asset class you want to hold for 20 years or 15 years or 20 years. Now let's look at what has been the India experience. So, on the left side, on the Sensex, we can see that, these are the levels at which the levels are first achieved by Sensex. So essentially, you can see that over a 32-year period or 33-year period, Sensex has given you something like 57x. And the IRR is 13.2%. This is a price IRR. To get to total returns, we add the dividends. I've assumed 1.5%. I don't know the exact numbers over a 30 odd years. So this total comes to 14.7% or 15%, which everybody keeps claiming. But the point to note is that it has to be linked to inflation. So inflation on an average during, or the geometric mean of inflation over this period was 7.08%. So essentially your real returns was somewhere around 7.5%. See, we just saw from the other data point that 6.5 real returns, 6.5 is exceptional. 1 to 5 says that anything over 5 over long periods of time for a market as a whole is pretty decent return, because not many countries have able to achieve more than 5% real returns over a very long periods of time. When we come to Nifty, this is 96. So essentially, we can see that the same data, the returns have gone down. It's 11.8% IRR. Their dividend is 1.5. Essentially, total 2.58. Inflation is 6.39. Real return is sub 6.19. This is more realistic data. So essentially, what seems to happen that I believe that in 1990, probably the markets were way too cheap compared to what it is now or we are used to. And so probably this is unlikely to return. So base rates of investing would suggest that today, if inflation is 6% and going forward, if we assume inflation is going to be 6%, you should expect, including dividends, you should make somewhere between 11% to 12% on market basis, 10 to 12%. And if you avoid big mistakes, common mistakes, you can probably improve that return by 1% or 2. And, unless, of course, you're somebody very exceptional, have some edge compared to somebody else in the market, you might do much better. But we are talking here of averages. Now let's come to why real estate. So this is another study which was done for these 16 developed market over 122 years. These are the countries, the Australia, Belgium, Denmark, Finland, so on and so forth. And it has United Kingdom and US at the end. So assuming that you would have held all of these markets in an equal weighted portfolio, this is what your results would be, right? So we never look at mean returns because, mean returns gets impacted by volatility. So essentially, you should always look at geometric mean returns. So they have assumed, as per their study, they have assumed a rental yield on the housing market. So at least as per this, you can see that, bills gave you 1%, bonds gave you 2%, which is what we just studied from another study, that these are the ballpark numbers. This is exactly, that's where this is. Equities gave you 4.66 for the world. That is also looks similar to that study, that's around 5%. And housing, at least as per them, gave you 6.62, right? This was over the entire period. The second section is, I've highlighted these boxes in red. Post 1950, if you see, you will see that, again, the similar study. Now, I don't want to get into what is better, equity or real estate. Probably equity is better for India. I don't know. But I'm saying that real estate merits a allocation in your portfolio. How much is something for you to decide. But at least the data tells you long-term, really long-term data across countries that real estate can do as good as equities in a lot of parts of the world. So this is another third study. This is the BIS study. Again, here it's only price returns. They looked at both advanced economies, and now we have New Zealand, Spain, etc., everything added, and also the emerging markets, which is where we are one of the countries. In this study, they did not include India because probably we don't have long-term data in pertaining to our Oz checkered. Now only RBI is trying to maintain real estate pricing data in terms of HPI index and all that, but that has happened recently for the last few years. So we don't have long history of organized data. So essentially, I'll come to the message here, but let's look at why real estate again. This is the data for residential inventory of the top 7 cities in the country. You will see that post the last cycle, it peaked at around 42 months inventory in 2017, and we are at 19 months, which is at a 10-year low, right? The next chart you can see below is the affordability index. We are again at multi-year high in terms of affordability. What this chart is saying that what is the percentage of your EMI as a part of your income, right? So from that point of view, if we are at 27, only 27% of your income goes towards mortgage, and this data is compiled by or maintained by the likes of HDFC and SBI. So all those lenders maintain it. So we know again you could look the same data across different ways. One other way to look at real estate is price to income ratio. You will see across cities, between 2010 and 19, we are significantly better off compared to where we were in 2010 to 19 across the cities. Now, we may argue that what is included, what is not included. And I keep saying to people that it doesn't matter. As long as we are consistent across the both periods, that's what matters. So if you made an error or, like for Bombay, if you're including the larger Bombay like Panvel, etc., metropolitan region, as long as you've done for both periods, the message stays loud and clear that in 2019, 20, we were much cheaper than what we were in 2010 in terms of our paying capacity. So the same data again is the fourth chart also shows that across cities over 2010, 15, 20, and 21, what is the proportion of income is going towards your mortgage payment or EMI payment. So you'll see that across the board, we have become cheaper than what we were 10 years ago. So why I am talking about this is to kind of demonstrate that we are not at the peak of the cycle. There is no bubble in real estate today. Probably Bombay is the only expensive market. I won't say bubbly, but expensive market in the country. But if you look at global data, all financial capitals of the world tends to be more expensive than the country average. And I don't know the reason why, but that's what the data at least shows. So let's continue why real estate. Now I'll summarize the what the BIS study said, that long-term real price returns, and this excludes your rental yield, is roughly between, it says 2 to 3%, but it's actually 1 to 3% depending upon where you are in the cycle. But these are very long-term returns, or how developed market you are, or emerging. Emerging markets tends to have higher long-term returns compared to your developed market, right? So essentially, India inflation is 6% today. It's fair to assume that you would, over a very long period, you will make 7 to 9% nominal returns, assuming these are only price returns, assuming the inflation stays at 6%. Now, from the last slide, we saw that, the last few years have not been great for the markets. That essentially means that we are not in bubble territory. We are either at median level or below median. So even if you are at median levels, you're going to make 7 to 9% in price returns. And if you are below median level, chances are that will make much higher. Now, the other interesting data point, or it's obvious, which everybody knows this, that this increases and decreases in cycles. Typically, the length of an upcycle is 2x vis-a-vis the down cycle. So if you had a really bad down cycle, the odds, again, these are the averages, the odds of an upcycle is significantly higher. Now, total returns will be much higher once you add rental yields. So let's say I'm going to make between 7 to 9% in nominal terms. And if I, on a median level, right, if we get an upcycle, which I seem to believe that we are beginning to see an upcycle, but that view can vary from person to person. It's likely to be higher. And if you're looking at residential real estate market, you get anywhere between 2 to 3.5% rental yields, depending upon where you are in the country. So definitely, if I add those two numbers, we're looking at 9 to 10, 11% on residential real estate. There may be some friction cost in terms of maintenance, taxes, etc. You can hive off or take off 1%. You will still do better than what you would do from bonds, from current point of time. And of course, if you were to take leverage and the tax arbitrage, which is inherent in real estate, your returns will look better as long as it's higher than the bond yields or your cost of financing. So essentially, we have talked some of these things, that Indian market currently the affordability is multi-year high. So chances are that we are likely to do much better going forward. Now let's look at the commercial real yields. Most markets, if you were to, if you have a property and you lease it out to a bank or a showroom, like say Nike or someone or a Domino's, you would see that the commercial real estate rental yields, cap values are 6 to 8%. What is cap value? Cap value essentially says that if you, if your property is worth 100, you're likely to get 6 to 8% annual returns from commercial real estate. Or, so total pre-tax, pre-leverage returns, this can be 14 to 17% this cycle. Why? Because, given that even if you assume median returns for the cycle, inflation is 6%, 2 to 3% is 8 to 9%. If you add these two, we are talking of 14 to 17% return on commercial real estate. Leverage will enhance it further. Again, I'm not asking anybody to take leverage, but generally people who invest in commercial real estate, do take leverage to enhance it. As a disclosure, my family and we do invest in physical real estate showroom spaces, and our experience so far has been very, very good. So, anyway, even if you assume only inflation returns, right, only 6%, your total returns because of the high rental yield is, if I take a median of, or the average of these two, 7 plus 6, 13% per annum, which is what Nifty has given you roughly over the last, 20 odd years. We have seen that from the earliest chart, where we are seeing what happens over 35 years when we compound at 15%, it's magic. So again, I don't want to say that one should invest in equities or real estate. As far as I'm concerned, I have exposure to both, right? Because I don't know at what period of time which will do better. So now let's come to what is REIT, right? REIT stands for Real Estate Investment Trust. Essentially, this is giving you fractional ownership of those properties. Now, what is the problem for a retail investor trying to invest in physical properties on their own? The knowledge, the time, the quantum, the liquidity, all these things are, big issues. So actually in the 1970s, US government realized that, real estate was disproportionately benefiting certain developers, and they came up with this idea of this fractional ownership, where, large masses could benefit from the boom in the real estate market. Now, There are also certain safeguards built in place so that developers or the sponsors of these REITs, real estate investment trusts, cannot abuse the power or the trust of what their investors have given them. So by law, they are required to distribute 90% of cash flows, right? Net cash flows. So essentially, they can't, a developer cannot, if it's registered as a REIT, they can't say that I want to build 10 new properties. So this year, I'm not going to distribute cash flows or dividends. In this case, it's called DPU, and we'll come to that what DPU is. Will not distribute these cash flows. Mandatorily, they have to do this for them to be qualified as a REIT, right? So this gives you certain amount of certainty in terms of cash flows, what you are going to get. So, and we'll come to, the Indian government has done a good job of putting restrictions in terms of leverage, etc. We'll come to some of those points in subsequent slides. So at a very, very high level, at a 10,000 feet level, essentially how you should look at REITs as a hybrid between equity and fixed income. Fixed income, people like yield and certainty. And, it's the least volatile asset class. Equities, on the other hand, it's largely growth oriented, where the actual cash flows given back to the shareholders, which is in the form of either buyback or dividends, have gone down over the years, right? REIT sits somewhere in between. It is less volatile than equity because it has a yield component, and it also grows, which is better than fixed income. So it sits somewhere in between both the asset classes, which is fixed income and equities. Now, this talks about in India what are the assets which REITs in India can own. It has to be earning real estate assets, right? So essentially 80% of the projects which REIT owns has to be income generating, or rather completed. They can't have more than 20% of under construction properties in their portfolio, right? In India, the current REITs we can have of offices, hotels, retail, industrial, healthcare. But right now, what we have is largely only offices. And in you have infrastructure which is called InvITs, which is not permitted in India, is residential REITs, right? Or anything to do with purely only land, right? And this is something allowed in the US, but not allowed in India, which is residential REITs. Now, government have also put a leverage restrictions on REITs. So REITs as a whole, if they have total assets worth 100 rupees, on their own, without seeking shareholder approval, they can go to 25 rupees of debt. So essentially 75% equity and 25 rupees debt. With their shareholder approvals, they can go up to 49 rupees of debt and 51 rupees of equity. So essentially, under no circumstances, REITs are allowed to have more than 1:1 debt equity leverage, which is different than US. US is much more leveraged. So what this do is that, in an upcycle, it caps your, upside, because, there's no limited leverage or not as much leverage as they could take, but also the downside during the down cycle. So essentially, it makes it less volatile. What are the benefits of investing in REITs? Liquidity. Now, REITs allows you to get an exposure to real estate and at the same time sell, real estate worth 2 lakh rupees, also 2 crore rupees, whatever you want, given its listed entity. It's highly transparent the way it's structured, given the rules and regulations. Each of us typically invest in real estate market in your local markets, right? So somebody like I'm sitting in Calcutta, probably I invest in Calcutta. I've spent a decade in Bombay, maybe I do there, but you don't go venture out to other parts of the country. REITs give you a way to invest in the complete national or a large part of country on that basis, right? So asset quality, your fractional ownership, the diligence you don't have to do, your professionally managed sponsor is doing that for you, and distribution again. We talked about the cash flow part, which gives you that at least 90% of the cash flows has to come semi-annually. In India's case, all the three listed REITs give it every quarter. Now let's look at what is DPU. Essentially DPU is what dividends is to your stocks. It's called a distribution per unit. This is the cash flow which investors get every quarter through these listed REITs. Minimum 90% has to be distributed of the net cash flows. It comprises of three components: dividend, which is a tax-free component. In India, if you're using the old income tax regime, which all the three players are using, return of capital. There is a tax nuance here. Just before this budget, it was completely tax-free. This budget made it taxable at the marginal rate. Then the amendment came last week of March, which again made it a little more nuanced. And we'll come to the end of the presentation about talking about that nuance. And the interest is taxable part. So essentially, dividend is tax-free, interest is taxable, return of capital is, as of now, with the current rules, it's largely taxed. And I'll come to that, how it calculation happens. And this gives you the breakup of all the three, players, listed players. What was the breakup in the third quarter? You can see that, for Mindspace, 93% is dividend, so it doesn't make too much impact to them. The rules, the current rules, and for both Embassy and Brookfield, the repayment of debt is a pretty large component. So these were the two guys most affected by the budget, and of course, a large, they represented to the government, and government heard and made it much more reasonable under the amendment. So let's go back to what are the different types of REITs, globally. What we have discussed so far are equity REITs, which fractional ownership of income producing real estate. There's something called mortgage REITs and M-REITs also in the US, where they take ownership or fractional ownership of those mortgages. Let's not go into that. At least that's the outside the scope of this presentation. Let's look at what are the different types of equity REITs we have in the US. You have retail REITs, shopping centers and showroom. This is my favorite. This is what we invest in, physical real estate. If if a REIT comes tomorrow which owns high street retail assets across the country, all the bank branches, all the Domino's assets, all the Nikes, and or different similar type of assets. So because these are critical to the business, these are income generating places for the companies which operate out of here. These are much more resilient than an office, which can tend to be looked upon as a office or a cost center. Commercial real estate, office largely, which is what we have in India right now. Residential real estate is not allowed in India. You have very designated lodging and resort REITs, which invest in hotel and resorts in the US. Again, this is likely to be very high beta. If you get the cycle right, they are going to make you a lot of money. If you get it wrong, you're going to lose money. Self-storage REITs. So it's a very interesting concept. In the US, you have people, who have large storage spaces outside of their house. It's like, think of what we have as bank locker for our valuables, but these are very small. These storage spaces are much larger. So, say 100 kilometers outside the city, there is a semi warehouse which for personal space, right? So everyone can go there and have a allocated space for themselves where they can have a storage facility. So that's very specific to the US. Then you have data center REITs again. So both storage REITs, self-storage REITs and data center REITs are something which have done phenomenally well over the years. Data center REITs is, as we are going more and more online, everything is going to cloud. Data center is where those data gets stored. and India has been forcing all the global guys to keep that data in India. So this is going to be an exciting space going forward, as and when you see a data center REIT in India with a reasonable yield, it at equal yield. This is more as things stand. This is more attractive than a commercial REIT. Infrastructure REIT is there, or InvIT, road, power, pipeline, cellular towers, etc. One big difference between REITs and InvITs is that in REITs, because you own those assets in perpetuity, you can that will you own those assets in perpetuity. In InvITs, what happened is that some of those assets uh, may not be held in perpetuity. They may be a fixed tenure asset. So by definition, InvITs yield has to be higher than REITs, because these are not, or some of the assets are not held in perpetuity. Now, so this needs a lot more work. I have not done the same level of work on InvITs as REITs, because I'll have to go to a project level data to understand which asset, whether it will get released, will or its build, operate, and transfer model. Some of those things. It has a lot more nuance. So that's why InvIT real yields are higher than REIT. Doesn't mean that from a long-term perspective they are that it's better. Then we're coming to industrial REITs. This is distribution center and warehouses. This is again is a very exciting area for India post GST, when octroi and all the entry taxes across the country kind of got waved away. GST is a consumption-based tax, so you want to be closer to where your customers are. So manufacturing is irrelevant. In the earlier structure, it was a manufacturing-based taxes. So what happens is that outside every large population center, people would want to have the distribution center, and this is why you order a phone online and you get it next day, because that's been housed somewhere in a warehouse near you. So this is going to become really, really big over the years, as and when the country becomes wealthier. US has another very fascinating REIT, which is timberland REIT. So the data suggests long-term data that returns from timber has been as good as anything else, whether equities or as debt, anything, right? So the returns have been very, very attractive over a long periods of time. So they also have a timberland REITs. So some of these things will come in India in due course of time. Now let's look at the global experience in terms of what the returns have looked like. You'll see that this is a 45-year data. It starts at 1972, and it's till 2017, at least this data. And it tells you that these are total returns. The REITs gave you 11.8%, stocks gave you 10.6%, international stocks. This is from a Morningstar data, so it's from the US perspective, give you 9.6%. Long-term government bonds gave you 8%, and treasury bills gave you 4.7%. These are, of course, nominal returns. So the message here is that over as long a period as 45 years, something like REIT can outperform the stocks. Again, I don't want to get into stocks versus REITs. As far as I'm concerned, both are good asset classes, and we should have exposure to both. As far as what allocation needs to be done, that's left to the individual to decide what or how he views the market over the next 5, 10, 15 years. This is another same data in a slightly different manner. As you see that over a past 20, 25 years, the REITs have outperformed the S&P 500 significantly. These are total return, right? So dividends are added. But over the past 10 years, thanks to the all the tech stocks, your S&P 500 returns have been better than what the REITs have been. And that's true for last 5 years also. Current year also, the US REITs are struggling. But that's not the point. What I'm trying to say is that despite all that, at the end of 2021, past 25 years data, if you look at, REITs had outperformed. So essentially, that means that if you ignore the last 10 years, prior 15 years was even better. So that means that, we understand that these are cyclical assets, which is likely to give you reasonable returns over a very long periods of time. And if you get your cycle right, they can trounce your equity market returns quite handsomely for a very long periods of time, right? So let's not. I've seen a lot of people on Twitter kind of dismiss real estate, out of hand, like it's a horrible asset class. Data suggests otherwise. Whether we'll get the same experience in India for the next several years, I don't know. But at least history of the world suggests that we are very likely to get similar returns as far as what we have seen across the world. This again is another data updated, absolutely recent data as of February 2023. You will see that the returns have not been great for the last 12 months for real estate and so for the REITs. But US has some very unique problems, given that interest rates are going low for so long that that their discipline was different. They have taken a lot more leverage, etc., which at least by regulation is not allowed in the market. And of course, the structural story is also different there than what we have in India. Now this talks about the breakup of the return. Where does returns come from? So roughly as per this study, 65 or 2/3 returns of the long-term returns comes from dividend, right? Or the DPU in our case, and only 1/3 comes from price appreciation. So essentially what we are trying to say is that because so much money comes to your pocket over the period of time, and if you don't reinvest that money back into the same REIT, it has a very dampening effect on volatility. This reduces volatility. So as a good rule of thumb, anything with a high dividend is likely to be, whether it equity or REIT, is likely to be less volatile than something which doesn't. So let's come at what is the diversification benefits of having REITs in your portfolio. So this compares between both your real estate as well as if you were owning REITs, or which is a proxy for real estate and stocks. There was a period that it was a 0.34 correlation. The global average is around 0.65. So you can seem to conclude that your likely correlation over a long period of time would be somewhere between 0.35 to 0.65, which is a pretty decent kind of diversification you are getting from real estate. So if I look at from the data, if I look at 2 periods where your returns in terms of correlation, in the tech bubble of 2000, there was hardly any correlation between equities and REITs. Equities cracked, REITs did not, right? So, but in 2008-9 GFC, the correlation was as high as 0.8, 0.9. So essentially, the bottom line is that they're likely to give you diversification, though there may be periods where it goes all the way up high, but over a long period of time, it's likely to give you a lot of diversification benefits. Now let's come to Indian market and why I think from a very high level, first principle point of view, why I am so bullish on the markets, right? So this is kind of your global top cities where most of the offices are. You will see that broadly the world average today is $4 per month rental. India is currently at $1 per month in most cities, right? Except of Bombay and parts of Bangalore and NCR. Pretty much it's $1 per month. So for you to get to global average, which is $4, these are, we are talking of, let's talk of real returns, right? Because inflation will kind of get impacted everywhere. So in terms of real return, we know that, you kind of get 1 to 2% or 1 to 3% annual returns. So for you to become 4x, even if you have to become 2x at 3%, is going to take you 24 years. So essentially, for the next 10, 15 years, it's unlikely that we will continue to be cheaper to the global cities. and tech is going to help us shift a lot of those offices to India. And this is only one part of the cost for those global GCCs or tech companies. Remember, manpower is also cheaper. Owning a place is only 25-30% of the cost for overall cost. So given all those benefits, this trend may continue for a very long period of time. Another very large macro point which I keep remembering is that India, in terms of total space, the country's overall space, in terms of density, is 9x of US, right? At some point in time, that is also going to have its own impact, right? Even China, which is only comparable country to us in terms of population, has a much bigger area than what we have. But anyway, that's something which is decades later that will play out. In the next 10-15 years, this theme should play out what we are looking at in terms of our attractiveness as a destination for uh, global offices, for all the Fortune 500 companies and the like. So this was more of a macro long-term point of view. Let's look at more tactical short-term situation, what has happened. You will see that what has happened that, most our commercial real estate is focused on these top 7 cities, and of that, Mumbai, NCR and Bangalore does the bulk of the heavy lifting. Probably my sense is 65-70% of offices are here in these 3 markets. You can see the trend. Between 2012 and 2019, the vacancy levels of these offices kind of went down. Of course, here it's projected. We'll go to the next slide. It'll show what actually happened. So from 20 to 23% all the way to 10-11%. So that was the projection, and this is what happened. So around 11.6%, it kind of was the low in 2017, and it has peaked to 17% now. So I know that 22% was the peak in 2012. Chances is that we are close to the vacancy peak. Probably another few quarters maybe is what we are likely to see as underperformance. And so somebody may argue that then why should we invest now and not later? Because I think market does a very good job of discounting 1 year forward. It does a poorer job of discounting 3 years forward, and it does a horrible job of discounting 5, 7, 10 years forward in most cases. That's the reason that, for us, most of the retail investors, it's unlikely that we will absolutely get at the bottom. At least my strategy is to keep allocating to the asset class, given 7.5% returns we are getting in returns, and whatever appreciation we get seems like a reasonable return. Now let's look at the players and the landscape in India. We have Embassy, Mindspace and Brookfield. These are the 3 listed REITs in India. Capital Land India REIT is an India-focused REIT, actually the oldest one, but this is listed in Singapore. And DLF, the listed entity, owns their leasing business or office leasing business inside of their listed entity, where 66% is owned by DLF and the 33% is owned by the Singapore government, right? So, and at some point in time, this will also come to the market. So if somebody is very positive on both residential real estate as well as commercial real estate, DLF is also one way to play it. But my focus is on the 3 listed REITs, precisely because today we get some sort of certainty in terms of what is the level of cash flows which I'm going to get, some level of predictability. So you can see from this chart that Embassy is the largest player in the country. So roughly the stock today is somewhere around 800 million square feet of grade A property in the country. So we can see that Embassy owns 5% of this thing. And I was speaking to a friend at KKR who does lending to commercial real estate players in grade B. He's saying you're seeing a long consolidation happening. The cost of borrowing for these institutional guys is significantly lower than those guys. So MSE is borrowing today at 7.5%, 8%, even in this market. They recently closed one facility financing at around 8%, right? Which is actually cheaper than yours and mine home loan also. And a mid-tier developer would be for him to difficult to raise financing below 13, 14% or even 12, 13%, unless you're a grade A top tier developer. So essentially, this is going to get even more consolidated. The top, these guys, the market, essentially, the way I see it, in terms of office space, you'll have 7, 8 pan India players, and that's about it. So this consolidation we are happening, and that's also the reason that which I like this space, because every time in an industry you see consolidation, the top players benefit disproportionately. So now let's look at what is their gross asset value. Essentially, what is gross asset value? The total value of all the assets put together. And by law, you are required to get it valued by 2 independent valuers, right? And what is so you can see that this is the total value of embassy, right? Here 50,000 crores, and of which 89% is completed and only 11% is under construction. We know that as per law, they're not allowed to go beyond 20%, right? So again, this gives you some flavor of what is the data is. Now let's look at GAV by geography. So, the beauty of the 3 listed REITs is that they are focusing on different markets. Even though it's offices, they are looking at different micro markets, and real estate works on slightly different dynamics for different micro markets. So if you are bullish on Bangalore as a office hub, Embassy looks like the play. If you think, their focus is largely Bangalore, 73, 74%. Your mind space is split between Bombay and Hyderabad. Brookfield is largely NCR and Calcutta. And of course, DLF is very high on Gurgaon. This again talks of your valuation comparison. Essentially, the focus here should be, this line 391, 378. These are the NAV. These are the price. So essentially, we're saying what is NAV? The gross asset value is the overall value of the assets or those properties valued by independent valuers. You subtract the debt component and some adjustments, you get to NAV. So every time you have large discounts to NAV, to my mind, that's a good enough time to get into those assets. The assumption being that we don't see a fall in NAV, right? So we don't consider, if you think that real estate is not even going to appreciate, right? Like in the US, because they appreciated absurdly over the last 3-4 years pre-COVID, during COVID times, at 2% inflation, the property prices were going up by 10-15% per annum. So it's obvious that whenever the correction happened, it has to be of the similar magnitude. But the Indian situation is very different. We have an inflation at 6%. Long-term averages means that it should grow at 8%. So bottom line is that I've not put that chart. If even in the US, it has been a good outcome every time the REITs went below more than 10% discount. And in fact, overall REIT, of course, their REITs basket is very well diversified. Every time they went 20% discount to NAV, it gave phenomenal returns to their investors. So in India, we don't know how the experience is going to play out, but the current discount to NAV is around 20%, as we can see. So essentially what that means is that our DPU today, as things stand, is between 7 to 8% for all the 3 listed players. Both Embassy as well as Brookfield are around 7.5%, right? So this now just talks about how the occupancy have moved. What we have seen is over the last 2-3 years, the DPUs have not moved, which has kind of disappointed the investors. Some was because of the COVID, some was because of the increasing, cost of financing, and also some was because these guys was not leveraged. So what they're doing is they're using leverage today to do brownfield expansion, which is allowed. So what they're doing is you're depressing your current DPU for future, because they are distributing 100% of their, by law they're required to do 90%, they're doing 100%. So then how would they do more growth outside of inflation or the price rise, right? But they are able to grow their total overall book by buying assets, by largely through debt, funded through debt. Of course, both of these guys, both Embassy as well as Brookfield, came to the market to do a primary issuance also when they were buying a certain bigger assets from their guys. So this is the occupancy level. And also one point to note here is that if you remove the SEZ area, which is where the India has some nuances around SEZ area. It's too technical, but if somebody wants to talk about it, we can talk during the Q&A session. This is the rent, how rents have moved over the last few quarters. Brookfield is this 65 to 63 is not comparable because they bought an asset here, which is a low rental asset around Calcutta. So that kind of changed their trend. Essentially, the trend would be similar. We know over long periods of time how they should behave or perform. So this again just talks about the GAV and NAV, how that has moved over a period of time. This is something which we should be keeping track of, right? Because we know that it will be volatile, but it would not significantly vary from the NAVs, right? So every time you see a large discount to NAV, it's a good time to have those assets. So as of today, we're talking of NAV of Embassy around 400 rupees, and it's trading at 320, 315, 320 odd. So we are it's around 25% or 22, 23% discount to NAV, which is pretty attractive. Now let's get back to what were the amended tax rules, how to go through that. So as I said that, if you look at the three components, interest or the rentals are taxed at slab rates. Dividend is exempt. And loan repayment, will come to loan repayment in the next slide. Capital gains on the price appreciation, short-term capital gains is 15%, long-term is 10%. The only nuance is that unlike stocks where you have to minimum or the long-term threshold for long-term capital gains is 1 year, here it's 3 years, right? So then under the new amended rules, how is your repayment of loan is treated? So what they check first is that how much, so let's say Embassy came or did the IPO at 300 rupees, how much component of DPU they have already distributed as a repayment of loan component. So if it's more than 300 rupees, right? So on an average, they're distributing 22 rupees, of which around 8-9 rupees is roughly your repayment of capital. So over the next 10-15 years, after 15-20 years, somewhere around that period of time, if they continue the similar level of repayment of debt, at that point, the repayment of debt component will become taxable in your hand. But at least for the next 10-15 years, what will happen is that it will get So the way to calculate this is if you bought, say, a REIT at 100 rupees, right? And you got 10 rupees as DPU over a 3-year period, of which 5 rupees was repayment of capital. So you don't get taxed on those DPUs or on that component of repayment of loan component of the DPU when you are receiving it. But when you're selling it, right, what happens is that because you got 5 rupees, that gets deducted from your cost of purchase. So for tax calculation, your cost of purchase is 95 and not 100, let's say you are selling it at 200 rupees. In the first case, if it was a pure equity, you would have made 100 rupees gain, 10% taxation is 10 rupees of taxes. In this case, you have 105 rupees of gain, and 10.5 rupee become your tax from a capital gain perspective. So that's about it. Let's get back to the summary and my investment thesis on this. Long-term real estate returns are similar to equity. Better or worse depends upon the period of time, but it's similar. We've seen that current scenarios are excellent setup. We last 5-6 years have been horrible for real estate. It's a severe underperformance, which increases the odds. We don't know what will happen, but it increases the odds that the subsequent period is likely to be much better, right? So that data suggests that we are either at median level or below median, which in my view is the more likely scenario in the current cycle. So expected price appreciation is 6 to 9% this decade. Even if I assume median returns, we're talking of 6 as inflation and plus 2 to 3%, anywhere between 6 to 9% this decade. REITs give you a great way to play this real estate investment, right? With 7 to 8% DPU and your 6 to 9% price appreciation, you're likely to make 13 to 17% IRR over this period of time. Now, tax advantages are there. Large part of your DPU today is tax-free, so that gives you additional benefits. It's highly liquid way to play real estate. Whenever you want money, you can buy. Whenever you want to park money, you can do that, right? It's a much lower volatility asset class compared to equity, and of course, it gives you diversification benefits to you as well compared to your portfolio. So the bottom line for me, it's a no-brainer investment for a fixed income investment. So for all of you, if you have allocation to fixed income, if you have FDs, then long-term FDs, then in my view, you should definitely have REITs in your portfolio. And this is something worth considering for equity investors, right? So if you are more of a index-based investor, then you should also look at this as an asset class. And I have no doubt that in few months or quarters or a year or two, NSE will come with an index of REITs and InvITs. I'm given to understand this is already in the works and this will happen. So with that, I finish my this talk, and I'm open to any Q&A.
Yeah, so I think Dipen Seth has raised his hand. He raised it long back. I'm allowing him to speak. And then after that, we have Mr. Kudwa. Yeah, Dipen, go ahead.
Hear me?
Yeah.
Okay, great. So quite frankly, I want to thank you for this. I've made friends with you recently, Agarwalji, and I'm extremely grateful that you did this. Having said that, as always, I'm a skeptic and I have some tough questions, as many as 6, but I will just start with 2 and then let others also participate.
Okay.
If I don't get a chance later, I'll feel a little victimized and I'll harass you personally. Okay.
That's fine.
Right. Okay. So early in the thing, in your presentation, you referred to dollar rentals in India as being significantly lower than the rest of the world.
Yeah.
So everything that you measure in dollars in India looks significantly lower than the rest of the world because of this purchasing power parity distortion. So I don't know how seriously to take that claim. Okay. Unless it is adjusted for PPP and I missed it, in which case I stand corrected.
No, so okay. So you want to list both questions, or should we do one by one?
Yeah, so this is one bit.
Okay.
The second bit is on the sanctity and practical accuracy of or durability of the NAV that is shared by the so-called independent valuers. We have so-called independent rating agencies, and that's a global, moral hazard. So I would just dismiss that number unless I see that number playing out consistently. If you give me an NAV for something, and if I see a transaction that happens at the NAV, on the real estate bit, not on the units, then I would assume that yes, it makes sense. Okay. So I'm skeptical there as well.
Okay.
Over to you.
Great. Both great questions. So the first one is easy. Actually, why wouldn't we want to look at PPP? Because who is generating this? The demand for offices in India. This is players based in the US. So they are looking at their cost, right? So if technology allows me to have as efficient office in Bangalore versus what I'm going to have in New York or San Francisco with the same level of efficiency, why the hell should I have it in New York? Right? My cost doesn't change because India's PPP is different than mine, right? Yeah. So that's why, if you look at where the demand is coming from, this is largely GCCs. What we have seen this first wave, which is ITES. Now, what we are hearing is you are seeing the manufacturing wave. So someone like Mercedes is going to have a 5,000 people sitting in India doing designing for them, right? Why? Because you have good talent available in India at very cheap prices. So, office is only one part of it. You also look at the talent cost. So the combined cost for them is a significantly lower.
Are you saying, okay, sorry. So are you saying that office costs in their India cost mix are insignificant for them to catch up with global costs?
So I'm saying they're not overall paying, cost.
See, you have to look at they're not paying dollar salaries which are comparable to Europe and the US. So why would they pay dollar rentals that are comparable to them?
No, but they are getting the dollar output. So I'll give you an example. Something which I was close to. I spent 10 years with Bank of America.
Okay.
So for Bank of America, outside the US, India is the largest office space, which is outside the banking business. They have a very large Bank of America Continuum Solutions, right? And we were doing, and that I was not part of it. I was part of the bank, but those I used to interact once in a while with those guys. They were doing very high-end work. So essentially, for credit analysis, if say I am a auto analyst sitting in India analyzing your Fiat or Volkswagen in Europe, what Bank of America was doing, that instead of having that analyst in Europe, who is anyway sitting in the office and doing data analytics or whatever research for his credit officer or his sales guy, they outsourced that piece of business to India. And as and when the guy would get promoted to VP, etc., if he was good enough, he was sent to the front office to do that business. So what they're saying is that, it's a pyramid. Only client-facing roles they wanted to have in those markets, and all the non-client facing roles were kind of, or to the extent possible, was kind of outsourced to India. So for them, it doesn't matter. They are looking at their European cost or euro cost or dollar cost. That it used to cost me $100 per employee, the overall cost of ownership, to deliver a value that I can get at $30, including both the cost of real estate as well as the cost of the person, right? So why wouldn't I have that? Which is what is driving most of the people to India. You hardly have such a large base of well-educated talent at such a cheap available prices. This thing is playing out in the individual market also. You'll be surprised post-COVID how many people are sitting out of India and Pakistan training students class 9, 10 maths tuition across somebody in Australia or to Europe and earning $100 an hour, right? Or $60 an hour, which is what the market rate is there. So that's on PPP. That's a very obvious thing why this is happening. So that has got nothing to do with PPP. That will play out when Indian companies start, generating that demand, where the local cost and the local returns is valuable. That is going to happen significantly lower. You will see that the entire focus of this market today is where the activity is happening in India, but it is for exports, essentially, service exports, right? The outcome is global. So the second is on the NAV path. Now, again, that's very correct. Incentive structures kind of decide how the GAV and NAVs can be calculated. But my point is, same what I was talking about those charts, as long as your methodology is consistent. Let's say I am over, valuing these companies by 20%, right? So over a long period of time, I am looking at my discount as the trend or the price history becomes bigger and bigger. We will know that what is the range of that discount to that value. So as long as they're consistent, my point of view is simple. So we have 3-year history. Of those 3 years history, today 20% discount is amongst the lowest we have seen over the long period, over the 3-year history. Now 3-year history is not as big as something like 20-year history, but at least from whatever data we see, we know even compared to their own methodology, today we are cheaper than what we were last year or last to last year. That's the basic point I want to make, right? That we are better priced than what we were yesterday. That's how I look at this point.
Hi, Praveen. There are some questions. Can you click the Q&A icon below?
Yeah, I see Ganesh sir's question on Desh bill. So essentially, I'll tell you, as we were discussing, a large part of these assets today are in SEZ. And as many of you would be aware that SEZs had a sunset clause. So what has happened is it's pretty bizarre. That shows how inefficient our systems are. So all the benefits have already been sunset, which were related to having your office space in SEZ. But the restrictions are yet to be sunset. So why would anybody want to have an office in an SEZ where you don't get any of the benefits, but you have to comply with 100 other things, right? So in fact, most of the occupancy or the vacancy which Embassy and Brookfield has is largely from their SEZ spaces, right? Outside of that, they are at 95, 96% occupancy level. Now, so the government was to come on a bill which is called Desh bill, where they would kind of rectify this. As things stand today, you can denotify a building. What these guys are trying to pitch to the government is, allow us to denotify a floor. So essentially what happens is, say, if you have a 10-floored office space and 9 of them are empty because new post a lease renewal, nobody wants to come in to comply with the current regulations or restrictions on SEZ when the benefits are not there. Only one guy is there whose lease is still remaining for 5 years. Because of that one guy, Embassy or Brookfield cannot release that or cannot denotify that entire building out of the SEZ and not and release it, right? So what is going to happen is, or at least what they are also trying to do is give an incentive to in a building like that to that one guy to shift into another building within the same premises so they can denotify that entire office space. So to my mind, this is an additional positive trigger as and when this happens, because immediately, Brookfield and Embassies, the likes of these guys, will be able to deploy these assets at some level of rental. I don't know how much, but it will be incremental to what the cash flows they have today. Okay, this is a pretty long question. Okay, so this depends upon what is your vantage point. See, if you're a trader looking at year to year, of course you can time it. But as far as I'm concerned, I don't stand a chance against institutional investors. I'm happy to be early because that's where I'm patient. I can hold longer. So that's the way I look at these things. And that's the reason which gives me the conviction to buy things when they look the worst, right? To my mind, interest rates are either at peak or are closer to peak. So from here on, whenever interest rates fall, which I don't know when, it will be again incrementally beneficial to these guys. So that will an extra kicker which will come in. So, if you can, but if somebody can time that better through some technical charts or something, please go ahead. To my mind, that's a tactical call. I'm more focused on the strategic call. Once you agree that you want to have exposure, how much, when is something, can depend upon each person individual, the way they look at this. See, again, we're not looking at the order book. That's not how CapEx or anything works here. Imagine I have only one building. Say I have we have some branches lent out to bank, or some real estate property lent out to bank branches. Even if I have that only single one asset, I get a rental yield which increases 15% every 3 years, and some price appreciation is happening, right? How do you calculate that? Say if I am today buying a property at 8% cap rate, essentially back calculating the value of the property for that property to give me 8%. If my uh, income or the rent increases by 15% 3 years later, I should be also be able to sell it at 8% to someone. So that means my appreciation has also happened at 15%. And most often than not, what happens is that once these 9 year, 9 year periods, typically that's the length of most commercial period, you have something called releasing spread, because contractual obligation was 15% every 3 years or 5% per annum or 4% per annum or 20% every 5 years, but actual market value moves higher. So when after 9 years renewal happens, it happens at a significant higher value. But for a single asset owner, it will be bumpy every few years. But someone like a REIT which owns multiple assets and multiple clients, someone or the other is releasing every year, so they are able to extract more. So there would be it will be a lot more linear in line with what the inflation would be with a lag, but it will happen. So capex is irrelevant to them. They can, and some of these guys have growth aspirations and they're doing it constantly. Currently, they are doing through leverage, or they have to go back to their sponsors. But for the thesis to play out, you don't need to buy more assets. I mean, that's not where the thesis is coming from. This is on Indore municipality have issued muni bonds tradable in the market. I have no idea around this is something which I don't know. I have no views on Indore municipality bonds, muni bonds. Okay. So the next question is from Vibhor. This talks about pros and cons of getting exposure to DLF for playing residential plus commercial. The REIT is the REIT asset held by DLF or the promoters? It's held by the listed entity, but part of it is also owned by 33% is owned by Singapore government. I don't want to talk about individual stocks so much, but if DLF is one of the largest listed players in the country, if the governance would have been better, it would have been a no-brainer. But given the governance, it's a lot more nuanced situation. But given where we are in the cycle, probably it's a good play or can be a good play going forward. The next question is, does the consistent selling from the sponsors in most REITs lead to longish periods of depressed prices, and may issuance of units at discount lead to destruction of value for existing holders? It's possible. Both Brookfield as well as Blackstone are seeing massive losses in their US portfolios, and my view is that's the reason that they're selling these assets here in India to fund some of those losses, or creating a kitty to focus on redemptions, etc. But at the same time, we saw that someone like Bain Capital kind of bought in MSC REIT. So my view is that some of this negativity around this REIT is happening because of what we are seeing in the US. We are at different cycles. They are at the top of the cycle. They've peaked and they're going down. We just bottomed sometime during COVID, and we have just seen early signs of improvement in the cycle. Commercial, not so much at this point in time, but residential real estate is hot. We're seeing messages like 7 crore flats, 300 flats getting sold within a day or two. Rents getting doubled in Bangalore market. And actually, REITs is that's a proxy for you to know that office occupancy is going up. What happened during the COVID period? A lot of people who were working in Bangalore kind of went to their hometowns and started working from there, because these large players were allowing work from home. Now, more and more companies are asking that you need to come to office, even if 2 or 3 times a week, or in a hybrid model. That is forcing these people back to Bangalore market, and suddenly they're seeing that for, with so many people coming back to the market at the same time, suddenly there is shortage of quality real estate, and we are seeing a boom in the residential real estate. Now, uh, to my mind, residential real estate and commercial real estate should go hand in hand, maybe with a lag, because what will happen is at the end of the land is the same, right? So if you see that benefits over a long period of time, if you see over a 3, 4, 5 year period, if you see that residential real estate is doing phenomenally well and commercial is not, most developers will have no incentive to build commercial real estate, thereby kind of reducing the vacancies. So it may happen with a lag. From the signs we see today, it seems like residential is definitely in a new bull market. Commercial probably maybe another year or year and two, we are away from that cycle to play out. So as dividend distribution is most efficient, any reason why Embassy and Brookfield are not distributing more of DPU as dividend? Are they likely to change their distribution strategy in the future? So this is a function of how income is reported in their books. In fact, as and when they are making more income, they are going to distribute more and more as dividend, right? So one good rule of thumb is, in for any player where the construction cost is much lower than or the income. So essentially, this will happen. Let's look at it that way. That my views over a medium term, the dividend component will increase more compared to what we have today. Nikhil has a question on what is your view on supply and demand in commercial real estate in each of the 3, 4 REITs, given the amount of supply coming in, especially in Bangalore, Hyderabad, and what's your view of impact on GV? See, I've not gone down to look at each micro level detail on these matters where the supply coming in. I'll tell you what my friend at KKR told me. He told me that the great way to invest, or the best time to invest in these would be in FY25, when most of the current supply would have come, though new construction is happening by tier 2 developers. If a guy like Embassy, I'm differentiating between Embassy and Embassy REIT, because in Embassy REIT, the Embassy only owns 8%. They are struggling with their debt on their books. So if someone like Embassy is not being able to develop new commercial real estate, there are very few people, developers, who would be able to do that across the country. So this is becoming more and more institutional. So it may so happen that we may see another year, maybe 2, of depressed prices. I am going to be a buyer across all those levels. I'll constantly, incrementally deploying capital if that happens. My view is simple, that over a 5-year period, I still see 6-7% appreciation per annum, at least in terms of my DPU, and my current DPU is at anyway 7.5%. In fact, some of these guys are doing brownfield expansion debt based. When that capacity comes to the market, they'll gain some incremental rentals from that. So my DPU is likely to increase, not only because of inflation, but otherwise also more than 5%. In fact, something like Embassy over the next 4 years may grow at 7, 8, 10% also, because of the brownfield expansion they have been doing. Rajesh is asking, okay, sorry, I missed one question which talks about how do you think of Phoenix Mills in terms of retail REITs? It would have been great, but they are not listed as a REIT, so they have no obligation to distribute 90% of their cash flows. So I would have loved it if they hive that off income producing assets as REIT. It will be easier to evaluate that, because then that they're going to mandatorily distribute certain cash flows, and they're not, we are not bound by the whims and fancies of their sponsors. So that's my only view on Phoenix Mills. DPU growth over the 3 to 5 years, I think it's somewhere between 6, 7 to 10% per annum. largely because of growth in existing yield or the rentals, as well as brownfield expansion, which some of these guys are doing, which will come on the market. So 3 years, I don't know, over a 5-year period, I'm very bullish. So the way I look at it, it's a 15% plus IRR product, which I think is a pretty decent asset class for an allocation. So that's it. I hope I answered all those questions. I see no open questions. Thank you for all of you for joining. And, if I missed something or there was an error, what you think, please let me know. I'm happy to correct myself and learn if any of you have any additional insights from this. Last but not the least, thank you, Arun. Aso is not here for organizing this presentation. Thanks for all the help. That's it, guys. I think with that, we can kind of close the presentation.